Okay, Regina Fisher, welcome.
Hello, Adam. How you doing?
Good to have you back. I'm doing great. So for everyone out there, this is the Business Nexus Roundup. We interview niche authorities, M&A advisors who focus on a specific space. And Regina, this is your third time with us talking about the FinTech niche, what's happening in the niche in terms of deal activity, what you've been seeing with your current clients and engagements and people who are coming and speaking with you before they're ready for a transaction. So we're going to pick your brain about the market and about what you're seeing and hopefully a little bit about what we can expect going forward into year end, since we have so many variables out there moving into this fall for year end, at least here in the States for everyone listening. So Regina, why don't you just briefly tell us a little bit about you and your practice, where you're based, and how you've gotten into the fintech space, just to set the scene, if you don't mind.
Absolutely. So Bristol Group Advisors, we are a M&A advisory firm that's helping specifically fintech companies when the fintech company owners, founders, when they're looking to exit. We're not here to help you raise your A, B, C, D series. When you get to a point, for whatever reason that is, you want to actually exit and sell the business, that's when we come in. We are nationwide. We have offices in San Francisco and on the East Coast, but we also service international clients. We're very specific. Obviously, we're very picky on who we take on as a client. And there's probably a couple of examples I can give why that is the case. Why fintech for me? I worked myself for about a decade in the fintech industry, starting on the payment processing side, strategic partnerships. I really love the space. It's so dynamic. There's so much happening. There are so many booby traps that a founder has to navigate. But then once you crack the nut, the business models are extremely lucrative, and it's just a fascinating space, right? I mean, we hear so much about regulators clamping down on companies and everything getting so overly connected and everything is so convenient now, and yet there are so many issues that pop up. So as a user, we use a lot of fintech. I've talked to somebody recently who said, "What is fintech?" And I said, it's everything you daily use just to get money, pay money, receive money, send money. And he was just completely surprised. And it was not a grandmother or anything. It was somebody who's working. What was he working on? Some kind of technology platform, but he just never gave the thought how he pays and where he gets his money from and how all that works. Actually, I mean, how does a credit card work? Most people don't even think about how does a credit card work. They think there's a cable that goes from every POS terminal to their bank. So yes.
Yeah, but this is why we do these, right? Because you're at the ground level, so this is common sense for you. But even like me, we're getting described as fintech. We're just an M&A platform. We've got some tech and a service on top of it, but we're really not. When you think of fintech, you're thinking of payments and credit card processing, et cetera. When fintech was, I think, a really hot item, everyone was trying to slap fintech on their company, just like everyone's trying to slap AI on it now. So I think it used to be a little bit of a broader term, but what you're seeing is very specific. So I don't think that's as intuitive for the lay person who's not you are day to day.
An interesting point, like where does fintech start and end, right? Is it a platform that services somebody that then moves money around? Is that already a fintech, or are you only a fintech as soon as money actually runs through your platforms? Obviously it's not, right? Because then only the actual banks actually really hold the money. Right? Everything is just technology that enables the movement of.
Or are you just a fintech company when you're putting fintech on your deck because you're trying to raise money from an investor who's focused on fintech, which I think up until recently we had a lot of. Are you seeing a lot of that? These fintech companies that maybe have kind of messy cap tables, or they've taken on traditional venture money, or they've done some safes, and now funding is kind of dried up, and so they're looking for alternative options. So they wind up kind of knocking on your door, asking, what's available? Could we get some sort of capital injection, or what are you seeing in that regard?
Yeah, well, everybody always needs more money, right? Where I see the bigger problem is, or they get into this institutionalized money raising. In that bootstrapped early stage, a lot of weird stuff happens. You take money from somebody, you pay yourself no salary and things like that. And that's all fine and dandy because you can't spend money that you don't have. But it's very, very important, and that's probably good advice for a lot of startup founders, is that you have to post all that very correctly into your balance sheet and your P&L. But it's mostly the balance sheet. Because once you go down the route and suddenly you have some big investors and money's coming in, how do you then get reimbursed for, I don't know, the $100,000 that your uncle and your aunt gave you? if it doesn't show up on the balance sheet. You still have to pay that back personally, but you really shouldn't, because it was money that made the company to where it is today. So you might have a $10 million company right now, but you're still not taking out enough money. There's still some cash flow situation issues, right? But you still owe these personal debts. If they're not on the balance sheet, you're never going to be able to settle that through the organization. You're going to have to do that personally. So that is something I've come across a lot recently.
And that's interesting for you, because you are right at that juncture where you'll have people go from an idea, right? Maybe they get some funding, then they get this thing, but then really once they're hitting profitability and it's turned into a real business, I mean, that, if I understand correctly, is really when you're engaged with your clients, is when they have that revenue and hopefully profit producing entity, and you're growing it to make sure that it's on track to get the type of capital that you would connect them with, as opposed to family, friends, and everything else you just described.
Yeah, again, we're not helping companies raise money, we're helping founders exit. So we deal mostly with small, lower middle market. So those are mostly companies that started bootstrapped and have made it bootstrapped to a certain revenue level where they're doing really well, or they've raised some money and now the investors are trying to get out, and then they hire us to exit. But in the first case, that's where we see a lot of the problems, because many times companies become a financial playground for founders and owners, and that's when you have the biggest mess on the books.
Got it. And so to clarify for the founders out there who might not know M&A so well, when you say exit, you mean sell 100% or
a majority exit, like meaning
right. So
majority to somebody else. And for the most part, and specifically in fintech, for the most part, we're talking to strategic buyers, right? Somebody that's in the field that already has something where that fits in very well as an add-on to the platform, or there's some cross-selling opportunities.
Got it. And so that founder who's thinking about options, and if they have something that is valuable to that strategic acquirer, they could be selling all of it, or they could be selling at a majority where they basically have new boss, but that have more resources provided by the acquirer, in theory, whether that's sales, whether it's marketing, whether it's new hires, the salary, roll equity into whatever that larger company is. And that's the value prop that you would help connect them to if they're selling out a majority of their business and not just walking away 100%.
Exactly. Or you sell 100% of this company, but you get some equity in the acquiring company.
Got it. And so the last point on that one, in terms of who you're working with, right? Because I think we're probably going to have people listening who are right in that idea phase, or have something where they've taken on 500,000 in family, friends, and they might not have opportunities going forward. At what point do you start speaking with fintech companies? Is it when they're at 500,000 cash flow? Is it at a certain revenue level? Or ideally, when do you start getting involved with these fintech founders?
Well, it depends. The thing is, when am I going to not be useful? Is probably the inverse question that I can answer better, right? I'm not going to help somebody sell their company. That's not profitable. I'm not going to be able to sell a company that doesn't have any customers yet, right? But if you have $2 million in revenue and 60% of your revenue is already recurring revenue from monthly subscription or something like that, and you're just above break even, and you have an incredible tech stack, and you have a great team in place, and you have a pipeline of customers and sales and a plan on how you're going to implement that, but you say for some reason, it could be health reasons, right? It could be you just had enough, you've been doing it, or two partners started this and they don't get along anymore. There's so many different places. Or you just see like, look, I know this is where I'm getting by myself now, but I can't, there's so much more opportunity out there. I can't do it by myself. And it would be cash flow impossible to grow that fast, right? And I just can't attract investors that just give me money. I haven't been able to do that, right? So then we can have a conversation, what we can do to assist.
Got it. And so when you have that conversation, say you take on the engagement, then you're starting the process of really packaging this fintech company, shortlisting buyers who would be interested in whatever offering they have, bringing that to them. But with the packaging, I know a lot of from this conversation, but then other conversations you and I had outside of the webinar, of the podcast, I know a lot of your time is spent putting together those packages, right? Putting together the information that a seller needs to have to present to the appropriate buyer, in a way that starts a competitive auction, presents the credibility for the entities so they can get the maximized valuation, et cetera. what ideally would you like to see a potential seller or a fintech company have when they come to you, or what are you spending most of your time kind of putting together? So the sellers don't have messy books, so they're not really in a position that you're going to have to rewind a year or pause a year while they get their books in order, et cetera. What can you tell us at that point?
Well, the key for me is that we have to be able to present this company very clearly to justify a purchase for a buyer, right? It's different from a pitch deck when you go after money, because you're pitching with this euphoria. I'm like, we're going to grow, we're going to go big, and your money, and da 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 da. It's a little bit different because now it's much more, this is what we have. This is what we can do. This is what you can take it. And it's all about more to the current situation and presenting that. And that's why it's so important to have everything, what I call just an honest organization, whether that's the books, whether you're very honest to yourself about how far have you gotten in your licensing and compliance and all these other regulatory requirements, how good is your marketing cycle and your client acquisition, what you actually have there, right? Because a buyer, again, the due diligence is slightly different. They want to see how can we integrate this up? Can we really take that to where we want to go with it, right? It's different than with an investor. They say if I dump money in it, are you going to be able to do something with it? In this case are we going to be able to do something, right? So that's why having a really clean, and I said again, honest presentation. There's something called the negotiation. It's called the accusation audit. That means you take all the terrible things that anybody could find about your organization. If they go through deep due diligence, what's the worst thing and what's all the bad stuff they're going to find? And I take that and I present it in the very first conversation. Why is that? Because I just told you the terrible thing, right? I don't know, the train wreck behind the building or something, right? And you're still interested. Later on, you're not going to say, well, there's the train wreck behind the building. And you're going to walk away. You're going to say okay, I've known about this train wreck from the very start. And now we keep talking about it, right? It's called accusation. It's extremely important in my case. So again, what was the question? What do I want these people to show? It is that be honest, be very straightforward. And then it's all about, of course, valuations. As we know, fintech valuations, they go between, I like to exaggerate, 0.6 and 345 multiple of EBITDA or something. But it's all about the justification. It's about, I have this is here, we already have that. And this is where we're lacking some information. And this is where you can come in and fix it.
Got it. And so that accusation audit, you're doing that before you get under the hood, or you're doing one kind of before getting under the hood and then after, once you have all the information, you're putting that together?
Okay, so I need to understand my client clearly. So that's when you say when I package it, we have these conversations. And often it's very hard to really pull the information out. Usually a company has hundreds of presentations and they've done some pitch decks and they're outdated and sometimes they're not in the proper language. It was half French, half English or something if it's international, right? There's tons of information. There's balance sheets and there's financial statements and whatnot, right? So we dig through all that and find out what is actually relevant. And then we use that, we package that, we start looking for potential buyers, we approach them with a teaser, and then the buyer says, hey, I'm interested. I have a conversation with them, and that's when the accusation audit comes out. That's when I say, hey, by the way, this is the problem, right? They've had regulatory issues, or they just lost their biggest customer, or whatever it is. It's just whatever this terrible story is, right? Because then the buyer says, oh, terrible, no, I don't think that's going to be for us. Okay, just go your ways, right? But I'm not going to waste my time or your time with that.
Got it. All right. And so in terms of what you're seeing right now, right, I know things are probably going to pick up a bit a week from now once we're in the post-Labor Day rush. But what are you seeing right now in terms of buyer activity? Are you seeing more of these first-time individual buyers out there, or strategics, or have private equity been deploying? Have they pulled back, or is it just completely dependent on the type of deal you're representing?
It's everything. There were about 500 deals in the last 18 months in fintech that I was able to find. Right? 500 something investments into fintech companies and almost an equal number of exits. So fintech companies being bought, but it was a little bit below 500, right? So there is some activity, right? Over the 18 months. It's an interesting time frame that's pretty much fully already, we're way out of COVID. Everybody's back in action. We've had high interest rates for the last 18 months. So that's a very good number to go by. But what does that mean? It means things are still happening. And this is, I mean, we're in the United States. It's always, I'm from Europe, the United States, things is always happening. People never get so depressed over a recession or whatnot. There's always activity. There might be a problem like high interest rates or elections coming up, but people are still going to do business. It's always going to go, right? So when I talk to my clients, what I always assure them is say, hey, look, ecosystem might not be ideally right now, or the situation might be a little bit like that, which is not perfect. But you always have to remember, you only need one, right? When you go after investors, you might need more because you might only get a small check from one. You need 5 other ones that follow the step and things like this. But you want to actually exit into a strategic acquirer, you only need one. And then it all comes back down. What's our value proposition? Do we have something that somebody likes? Then we're good to go. So the answer is there's activity. It's never zero. It's private equity is buying, strategics are buying, because again, it's so much easier to grow through acquisition than it is organically. It's all out, it's all happening. You mentioned Labor Day. I already felt the last 2 weeks were I'm swamped, right? Buyers are just wanting everything, asking questions, coming in. We're going to see a little bit of a slump again towards like Thanksgiving. People get a little bit lazy. And then they wake up and they go like, oh my God, the year end, we still need to do something. But there's always some activity. It's never boring.
Yeah. And you also have your finger on the pulse of that, somewhat finite universe of buyers, right? Strategics, you're talking with them, you know what they're looking for, private equity. So I'm sure they're trying to get a jump on all of this. And part of that is by reaching out to you. So
I'm sorry if I jump in here. In my case, very rarely do we sell to private equity, because most cases we're looking for a strategic acquirer. Because private equity might have some other companies in their portfolio that fits in, but not so much. It's much more often that it's a strategic acquirer that says, okay, if I instead of building this piece, I'm just going to buy it. You have this. Or instead of trying to break into this customer base that you have, I'm just going to buy you, and then I have that for me too.
Interesting. And that was exactly your role, to clarify, before you got into M&A advisory, before you got involved with Bristol. I mean, you were on the corporate side and you were doing just that.
Oh yeah, I was only doing strategic partnerships. Everybody wanted to work with me.
Yeah.
I mean,
And so
company I worked with.
yeah. And now you're in touch with those corporate venture acquirers on an ongoing basis in your role as an M&A advisor. Okay. So what do you see? I mean, anything relevant that you can tell us in terms of what you think is coming down the pipe through year end? Is elections going to change anything? Are people kind of holding off on transactions? Are they waiting for certainty or anything that's...
Without going too much into politics?
No, I'm not asking for that.
I think the election is going to be very, very exciting, and people are going to get very, very upset about it. But either way, business is going to keep on going. Banking is going to keep on going. FinTech is going to keep on going. M&A is going to keep on going, no matter who. Right? Obviously, there's a lot of worries about taxes going up, taxes not going up. That's going to impact everybody. But again, we live in a country where people just going to look at it, say, I like it or I don't like it, and then still do their thing.
Yeah. And okay, I won't press the point then. But you don't see any pause with corporate acquirers, corporate venture, people looking to go through acquisition. They kind of wait for things to settle and then look at their growth plans after the elections. You're seeing full steam ahead. Yeah,
because it's again, elections usually impact the stock market stronger, but we're over here, right? For a buyer, buying a successful company is an alternative to the stock market, right?
Yeah.
I can have my money in here, or I can buy companies that I control, because we're talking about privately owned companies, not publicly traded. So if I see an opportunity, are people going to stop spending money? Are people going to stop using platforms to transfer their money? No, it's like there's a lot of opportunities. So I don't expect elections to impact activity a little bit.
All right. I mean, are you talking with corporate acquirers who see this as an opportunity, right? I mean, if things slow down and they want to grow through acquisition, they have cash on the books and they're looking to acquire. I mean, some of these fintech companies might run out of options. I mean, is this an opportunity market for those buyers going forward?
For the buyers, you mean the price is going to drop? Sellers going to be easier gobbled up?
Yeah, if the sellers have less options, if there's less capital available to them, if you have buyers who are sitting on cash and they're looking to potentially go through acquisition.
Could be, but then again, I think it's not strong enough to say this is going to be an overall trend. There might be one or the other, right? But I don't think that's gonna be a really highly visible effect on the field.
Got it. Okay. All right. Well, then I will let you get back to your transactions. I know how busy you are, but thank you again for taking the time. We really appreciate this, Regina.
Thank you.
Real quick, for everyone watching, how can we get a hold of you if people would like to reach out?
BristolGroupAdvisors.com, Regina at BristolGroupAdvisors.com. Bristol, like the medieval town in England, Bristol. BristolGroupAdvisors.com. Thank you.
Perfect. Thank you, Regina. We'll see you next time.